So here's something that will surprise a lot of investors, but the price-earnings ratio is meaningless by itself. I know this sounds odd at first, but please hear me out. I will explain a bit more in detail. So here we go. The keyword here is by itself. We hear so much about low PE investing. We think this is equivalent with value investing, right? After all, a low PE means value. So here we have Marie. Marie is scanning for low PE stocks. She found a few and thinks she found the holy grail. So let's look at them more closely. So here we have Super Company Inc. The market cap is $1 billion and they made a profit of $200 million last year. Sounds too good to be true, right? Well, it is. Here's what the PE does not tell you. Among other things, the company could have negative cash flows, legal issues, declining sales and profits, high debt, and one-off events. So here's one of my favorite quotes. Profits are an opinion, cash is a fact, by Alfred Rappaport. Quick note, I will make a video about cash flows in the future, but to keep it simple, keep in mind that management has a lot of ways to improve profits. Company can actually be profitable, but cash is flowing out of the company year after year. The price-earnings ratio will not help you by itself. Always compare the earnings to actual cash flows. Another problem is that the company could have legal issues that could lead to huge fines in the near future. The PE will not tell you this as well. I recently invested in a company that faces those kind of issues, so please keep this in mind because it is a possibility. Another bigger issue is that profits could be declining. If the price is constant, the PE will be higher in a few years. This is not a scenario that you want. Another big issue is that the company could have an unmanageable amount of debt. The price-earnings ratio is based on market cap. The market cap does not include the debt. Always look at the enterprise value to see the real price of a company. So let's look at one-off events. The one-off events are events that won't occur regularly. The cash would come in at one time and it would not repeat in the future. This can distort the price-earnings ratio. So here's a sample. The company could sell parts of its business and book it under profits. This will distort the PE ratio. So here's what's even worse. If the company sold parts of its business, it will likely earn less money in the future, so the PE might be even higher moving forward. So as you can see, if you just look at the PE, it does not give you a real picture. One thing you should always do is compare the PE ratio over a few years. For example, 12, 13, 13, and then 5. So what happened in 2013? So if you're lucky, the PE dropped to 5 for no real reason, but that's usually not the case. My best guess here is that there was a one-off event. But what about the forward PE? It is a better indicator because it looks towards the future, but keep in mind that they are based on analysts. They can be wrong. All else being equal, a lower PE is always better than a higher PE, but things are never that simple. When you scan for opportunities, make sure you look at more than just the PE ratio. I believe it's one of the costliest mistakes a new investor can make. Usually, if a company has a low PE, there's a very good reason for it. Thanks so much for watching, and I hope my video will help you become a better investor. If you enjoyed the video, please like and subscribe. Thank you very much. I appreciate it.